Joining me now with more is Andy Walden. He's ICE's head of mortgage and housing research. Andy, great to have you on the show this morning. And let's kick things off. Mortgage rates falling in recent months. We've seen refinance activity pick up. What types of borrowers are you seeing jump in and take advantage of lower rates?
Yeah, and as you would expect, it's folks jumping in that have taken out their mortgage recently that are looking to drop those monthly payments. 19 out of 20 rate and term refinances that happened in September and October.
I do want to note that I don't hear Andy.
Took out their mortgages in 2023, 2024, or 2025 that are refinancing to reduce those rates. Among that group, it's your higher balance, higher credit score borrowers that are jumping into refinance first, right? So folks with an average credit score of about 760 and an average balance of $500,000 of those folks that are jumping into refinance here late this year.
Mortgage refinance retention, Andy, hitting a 3.5-year high. What contributed to the uptick?
And it's really stronger retention among those folks that have taken out those mortgages recently, right? Half of folks that took out their mortgage in 2024 that are refinancing were retained by those servicers. The playbook has become a little bit simpler. It's simply identifying those in-the-money mortgages inside of your portfolio and marketing to those folks. It's now all about efficiency, right? Are you the first one to the table? ICE did a survey earlier this year that says, folks looking to refinance really only look at 1 to 2 lending options before they pull the trigger on that refinance. So it's, quickly identifying those folks inside of your pools that have that incentive to refinance, putting the right product in the right place at the right time to attract those borrowers.
What challenges are lenders facing when it comes to identifying and retaining equity-seeking borrowers?
Yeah, those cash out refinances are a lot more challenging. Half of those folks are actually increasing their interest rate to refinance. They're not all coming out of those recent vintages. You've got some of those folks that are coming from 4, 5, 6, even 10 years out from taking out their past mortgage. And so it moves away from that in the money analytic to more advanced analytics out there, which a lot of lenders and servicers struggle with. It's where some of the value of more advanced products like Servicing Digital, where folks can self-identify as an equity seeker. They can understand how much equity they have available in their home. They can kind of initiate their process directly from some of those platforms, become even more valuable.
Second lien home equity withdrawals hit an 18-year high in the third quarter. What have you seen contribute to that rise?
Yeah, and that's really on the second lien side, right? And it's not overly because of equity growth. When you look at the amount of equity out there to borrow against, it's really flattened over the last 12 months or so, right along with home prices. So we have roughly the same amount of equity to lend on or borrow against as we did at the same time last year. The key difference is that equity has become more affordable to withdraw. So if you look at second lien home equity line of credit interest rate offerings, a year and a half to 2 years ago, they were at 10%. Today, they're closer to 7 to 7.5% in terms of those interest rate offerings. And when you look at what that means for the monthly payment to withdrawal equity, you look at a hypothetical $50,000 equity withdrawal, that monthly payment's gone from $400 down to $300, a 25% cut in that payment over the last 18 months or so. And then you were talking Fed rate cuts earlier. When we look at the path forward for 2026, that could mean even more affordable equity withdrawals as well. If the Fed were to move forward with 75 bips of rate cuts here over the next 12 to 18 months, that could cut those monthly payments needed to withdraw equity by another 15 to 20%. So it's just simply becoming more affordable from a second lien perspective to withdraw some of that equity.
Yeah, I think people have been waiting for lower rates for a while, Andy. And so how have you seen that change home affordability?
Yeah, I mean, I guess you got to look at it on two different hands when you look at it from a home affordability standpoint. On one hand, home affordability is the best that it's been in 3.5 years. You look at that share of median household income needed to afford the median priced home. It's below 30% for the first time in several years out there. It is bringing more buyers back to the market. So you look at purchase applications on a seasonally adjusted basis. They're the best that they've been in 3 to 3.5 years as well. So you're seeing some improvement. It's happening across the board. All 100 major markets across the U.S. are more affordable than they were at this time last year. On the other end of that coin, affordability still remains very stretched, right? And we're still several years out from seeing that fully normalize. So good news in terms of the context of the last few years, moving in the right direction. We still have a road to hoe before we get fully back to long run average home affordability.
Okay, so 2 years, is that what we're talking?
Maybe more, right? When you look at what it's going to take in today's market, it would take 4.5% interest rates. It would take 15 to 20% of additional income growth to fully normalize that home affordability standpoint. So we could be several years out from seeing things fully get back to normal.
Okay, good to know, Andy. So for those looking to make their move into a home next year, right? Affordability might not be the best scenario for them, but what other data trends should they be monitoring to get the best gauge on the state of the market?
Yeah, certainly. I mean, affordability is one, right? Keep an eye on what's going on there. Understand your monthly payment, what's happened in this lower interest rate environment that we've found ourselves in late this year. But the second is understand what's going on inside of your local market, right? We talk a lot about national housing market trends. You're not shopping in a national market, you're shopping in your neighborhood, in your zip code. So really understand what's different in your particular area. You've got Midwest and Northeastern markets that continue to remain relatively firm from a price perspective, and mired in still these deep inventory deficits. In the South and West, it's been certainly softer, but you've seen some sellers pull back from those markets as well, and things firming up a little bit there as well. So really understand your local market conditions, where you're shopping, what does demand look like there, what does supply look like there, what are the monthly payments required for you in particular, and shop that local market.
Andy Walden, ICE's head of mortgage and housing research. Andy, thank you.
Awesome. Thank you, Kristen.